Ron,
Yep.
Let's start with the bigger picture right now. This market rally was one that maybe some people expect because there are quote-unquote seasonal factors at the end of every year that make it kind of a positive time for the markets. But a lot of people didn't call the massive rally that we saw for the balance of 2023. What gives and can it hold?
Fed's done. Period.
And that's the reason why.
That's it. I mean, I can't identify any other reason. It's not like they're, raising guidance on earnings in such a dramatic fashion that, you're going to see the market rip on that basis, or that there's any other thing going, aside from the economy not falling into recession and the economy not falling out of bed. Really underlying this, Dom, I think, and I wrote about this on CNBC.com today, all the measures of inflation are moving towards the Fed's target far faster than anyone had anticipated. You take today's core PCE, over the last 6 months, it's annualizing at a 1.9% rate. What else do you need? So everybody knows the Fed's done. Everybody believes the Fed cuts next year. And so that's reason enough to rally.
All right. So the market rally predicated in large part by what's happening with the Fed. Mike, this is a scenario now where if you're an investor and you say to yourself, I saw huge gains over the course of 2023, I don't feel as comfortable putting money to work, though. But sometimes the momentum keeps on going. Do you feel as though this is one of those scenarios that Ron just laid out where the Fed is done and it's an all clear sign for the markets overall?
I think directionally, yes. I think in general, everything that Ron said, I tend to agree with. Inflation's coming down. That's good. Markets like that. The Fed is kind of being investor friendly, saying there's a pivot coming and investors favor that. So the question is, what happens next year? Is this going to be significant momentum? Are we going to see a repeat? Are Magnificent Seven stocks going to do the exact same thing again? That seems a little bit unlikely to see this massive outperformance from some of the tech titans out there. However, if we just try to put these pieces together, what's happening? Macros look pretty good. The Fed is cooperating. People have jobs. They're out there. They're still spending. If you look at stocks and look at, are they expensive or cheap? They're just a little bit expensive. It's not terrible. So that's a pretty good setup. I think we put all those things together. If you're a long-term investor, I think you stick with markets. There's, a good odds of a good result next year. Maybe not quite the massive bull market we've seen in 23, but I think there's enough positive things out there to keep folks in the game for next year.
It's interesting because, Ron, we're putting that kind of chart up there for the CNBC Magnificent Seven, those mega cap tech, media, telecom type names that have driven the bulk of this rally. This is one of those scenarios over the course of the last year where people have talked about a broadening out of the rally, that more than just those Magnificent Seven stocks are outperforming. It's been very evident in just the last 3 to 4 weeks, where we've seen the equal weight S&P 500 really rally to try to...
And the Russell 2000s.
Right, and the Russell 2000.
Yeah.
So my question is this. If it now becomes a scenario where it's healthier because it's broadening, what parts actually lead the way besides that technology trade?
So I'm not going to worry too much about leadership because I think at the end of the day, for most people, it's still an S&P play, right? And a lot of people worry about concentration. We were just actually talking about this at Dynasty this morning. A lot of people have worried about the concentration of the Magnificent Seven, their weighting within the S&P. Much unlike oil stocks in 1980 or even tech stocks in 1999, these are companies that are dominant in their position, cash rich, probably won't be unseated from what they're doing in their dominant role, effectively underwriting artificial intelligence, right? So I worry a lot less about that. I worry a lot less about leadership. You're getting a breadth thrust, which whether it was Ned Davis or Marty Zweig, they both talked about that over the course of market history. And so you can play the indexes and I think not worry all that much about, let's say, the Magnificent Seven being a source of funds, as opposed to the $5 to $7 or $8 trillion that's on the sidelines coming in and buying the market. So I think, I don't get too caught up in that stuff, particularly because these companies, while they could have a hiccup, seem in many ways, Dom, to me, less vulnerable than like oil companies, which are commodity price driven, versus these guys, which are sitting on massive piles of cash.